So I'm actually traveling right now. I'm not in the city, but this is a particular subject that I wanted to discuss with you. Now it's a massive, complicated subject, and it needs to be broken up over several videos. But I wanted to place before you the initial sort of evidence and have a conversation or start a conversation about this issue that we can then break up and do over multiple videos, right? So there's a concern right now in the market that young people are taking very risky bets in the stock market, specifically in the futures and options market, and they are losing so much money, it's driving their families into debt and poverty. Let's take a look at what is happening. And I want to start off by a statement that was made by the RBI Deputy Governor M. Rajeshwar Rao. And this is around the 21st of February when he was speaking at an event. He basically said that technology has led to people borrowing and using that money to trade. I want to quote what he has said. He said, just as the presence of too much light can lead to blindness, we must be aware of the risk of reckless financialization. And it's quite a stark thing to come from the RBI, given how much the RBI has encouraged digital sort of, finance, and the fact that we use apps in order to move money rather than cash. Now, what Rao was saying effectively is that while technology has deepened financial inclusion, which has allowed people to borrow money quickly, to trade quickly, to do transactions really fast because we have the tech, concerns have now emerged within the RBI over unchecked borrowing and speculative investments that could leave individuals and institutions vulnerable. Now, he's basically said that short-term gains is completely overshadowing long-term financial security. And this is being said mostly because both the RBI and SEBI have been worried about unsecured personal and credit card debt and, of course, risky trading. Let's take a look first at the unsecured borrowing, right? Now, quick detour. There are two kinds of loans. Secured loans, which is like a home loan or a car loan or a gold loan, where you offer some security and then borrow. So if it goes wrong and you don't pay, the bank has something to seize. There's an asset underlying in that loan. Unsecured loan is a personal loan where there is no security offered to the bank. Now, there has been an increase in just the sheer volumes of unsecured loans being handed out in India. And over the last year or so, the RBI was feeling very nervous about the fact that a lot of fintech companies were giving these small loans really quickly without actually checking whether the person had the ability to pay it back or whether they've taken multiple loans on different platforms because it was happening so quickly. The RBI had in fact tightened regulations for unsecured loans and sort of brought it under control a little bit, but obviously not enough if it's still being mentioned. Now, I did find this one interesting article in the Economic Times. It talks about the fact that demand for loan collection agents has surged 30% in the last 6 months. So Team Lease, which does a lot of the recruitment, has recruited apparently 7,000 new loan agents for various financial institutions for this one particular thing, with the focus of enhancing recovery efforts. Now, Fitch Ratings, which is a ratings agency and a research agency, has put out a report saying that it believes that it will be increasing stress on asset quality of Indian banks because of its unsecured retail loan portfolios, which means a lot of these loans have been handed out and now there's trouble actually bringing these loans or getting these loans to be repaid. And this was the projection for 2025. Now, Fitch has also said that the unsecured personal loans and credit card borrowing grew 22% year on year and 25% year on year in the 3 years leading up to FY24. It slowed down in the last year, but that's because the RBI put the brakes on it. But still, it's something that's causing the RBI some worry. Now, the other half of this problem is the speculative investments or F&O trading, futures and options trading. Now, SEBI has revealed that in the financial year between 2022 and 23, 10 million or 1 crore people in India actually engaged in F&O trading. 93% of those people lost money. They lost more than 1.81 lakh crore rupees, which means that each of them lost about, on an average, 2 lakh rupees. So 1 crore people lost 2 lakh rupees each. That is a startling number. Now, here's something that was even more interesting for me about this data. almost all the traders who have dabbled in F&O trading have, at least once have lost money. It's indicated that 91.5% of small traders, which means they're trading less than 1 lakh rupees, so these are not professional traders, they lost money. So 91% of people who had less than 1 lakh rupees in their trade portfolio have lost money. Reasons are market volatility, price changing, psychology factors, and basically you don't know how to do this professionally, and that is why you're losing money. It gets more interesting. A significant portion of these traders are below the age of 30. Apparently, in the F&O segment, people under the age of 30 rose from 31% of the total traders to 43% of the total traders as per SEBI report. So, 43% of these people who are trading F&O and losing money are under the age of 30. And they apparently, in spite of the fact that they are losing money, they continue to trade. So SEBI also says 75% of those people who lost money have continued to trade even after consecutive years of setbacks. So what is going on? And are these the same people who are borrowing money to actually trade? I want to take a second here and do a detour for those of you who are saying, boss, what is F&O trading? Okay. So let me explain this to you, what the futures and options market is. Again, this is a really simplified way to look at it. So with that caveat, now let's assume you are a business person, you have a factory and you're making cotton t-shirts, and you take orders to make t-shirts for the next 1 year, and you agree to the price of the t-shirts that you've taken an order for. Now the problem is, if the price of cotton increases sharply, it will throw your entire margin out of the window. And now you will be delivering t-shirts for more money, for less money than it took to make them, because the price of cotton is a raw material that's important to you making these t-shirts. So what do? You go to the futures and options market and you pay a small price to lock in the price of cotton 6 months from now. And you say, okay, if it's currently about, say, 1,000 rupees for a certain amount of cotton, and my comfort level is not more than 1,100, I'll pay 2 rupees as a margin to block this number 6 months from now. Then 6 months from now, if it's higher, you use your 2 rupee option and you buy at that level. If it is lower, you drop your 2 rupee option and you buy it from the market. Now effectively the idea behind this entire F&O market was to help traders and businessmen lock the price of commodities for the future. Hence, it is a futures and an options market. Again, I'm saying this is the simplified option of it, right? What happens though is that if you are not a t-shirt maker and you have no particular real business interest in the price of cotton, and you're sitting at your computer on your app and you're just like punting on the price of commodities and the price of stocks in the future, that effectively is gambling, right? Because you have no understanding of how this commodity is moving and you're not making an educated choice. So effectively, are these 30-year-olds and 20-year-olds actually just gambling in the F&O market, and are they doing it with borrowed money? And is that what SEBI and RBI are really worried about? Do you know anybody who's doing this personally? Now, this is what the futures and options instrument is. Like I just explained to you, we must also realize that there is no underlying asset in the futures and options trade. So for example, if you were to buy a stock, even if that stock fell, you're still holding that stock. It's still an asset in your name. If you were to buy gold or real estate and the price fell, you're still holding that asset. And you can continue to hold it till such time as the price comes back up if you choose. But in an F&O trade, what happens is once that expiry date comes, and if you lose your money is gone, even though it is a small margin. And so what happens is basically the leverage amplifies gains and losses, and it leads to really extreme outcomes. So when we're looking at a volatile market, as we've seen the volatile market, in the last few months, and we're talking about it a lot, for those who are holding stocks or mutual funds, there's a certain kind of loss. But those who are who are in F&O will be losing sharply much more, because it amplifies either the gain or the loss. So there's one expert who's been quoted by India Today, Puneet Sharma, who's the CEO of Whitespace Alpha. He's saying it's like gambling. Trading F&O can trigger an emotional response which is addictive, and traders continue to place bets hoping to recover what they've lost. So the more they lose, the more they try to recover it, and the deeper they get. There's of course what is called cognitive biases in the way a gambler's mind functioned, where you're basically overconfident and you keep thinking that no, one more trade and I'll get it back, one more trade and I'll get it back, and you keep going further and further in. What has happened then is basically it has made the RBI and SEBI extremely nervous. Last year, in fact, the RBI governor, the then RBI governor Shaktikanta Das, had actually said the volumes of the F&O market or the derivatives market, and I'm quoting here, is perhaps larger than the nominal GDP of the country. So that's the kind of money we're talking about. And basically, these are early warning shots by SEBI and RBI, but they're paying attention to the fact that the data is pointing to something really dangerous. There was another piece of information where basically the number of people taking loans against gold has shot up completely high because, remember, the price of gold has gone up, which means that, for argument's sake, if you bought X worth of gold in your locker right now, you could actually pledge it for a loan and take out more money than X because the value has gone up. But that also leaves banks in a really difficult position, because tomorrow if the value of gold comes down, the bank will be left holding an asset that is less than the loan that is handed out. And the person who's borrowed the loan might just give up that asset and buy the cheaper gold. So if you compound it across the banking sector, it puts the whole thing in a slightly vulnerable position. So there are several things that are going on right now that are worrying the RBI and SEBI. But fundamentally, this idea of young Indians borrowing money because they can do so easily on the apps and trading with that money, also done easily on the apps, is actually causing concern. Let me know in the comments section if we should talk about this more, if you've had personal experiences of this, if you know of people who are going through this, and if this is something you believe the RBI or SEBI should take a closer look at. Let me know what you think the regulators should be doing.